It is Financial Literacy Month, and to celebrate, CBS News business analyst Jill Schlesinger is answering some of your most frequently asked questions. Jill, good to have you with us. Thanks for being with us here this morning. So there has been a lot of talk about the bond market. Can you explain exactly what a bond is for the average investor out there?
Okay, gang, when you buy a bond, you are making a loan to an entity. It could be the U.S. government, could be the state of New York, it could be the city of New York, and it could be a company. You have this loan for a predetermined period. That's the term, and you lend this money for a fixed rate of interest. Now, the borrowing entity is on the hook for interest payments, usually every 6 months, but sometimes at the end of the agreement. At the end of that term, they've got to repay that obligation. And remember, the higher the risk that you don't get paid back, the more interest that the bond buyer demands. Just remember also that bonds can fluctuate in price during that term. That's because if you have a bond and it's paying 3% and someone can go out in the marketplace and buy something for 5%, you're going to have to lower the price to induce them to buy that bond. So, yes, bond prices can move, even U.S. government bonds.
So, Joe, can you explain something called compounding?
Yeah, because I love compounding. It's one of my favorite things. I'm going to give you an example. Let's say you put $100 in the bank and the bank pays you 5% annually. At the end of the first year, you've got $105 in the account. If you keep that money in the account for another year, you're going to earn another interest payment on both the original $100 and the $5 you earn. That is compounding. At the end of the 2 years, your money grows to $110.25. Remember, time supercharges how much money your money can grow. So that's why we like people to start saving early and keep that money going.
And just don't look at it. Just put it away, tuck it away, and just let it continue to compound. All right, so most retirement plans offer target date funds. What are they, and should we use them?
You know, I think these are kind of interesting funds because basically a target date fund will allocate your retirement money in stocks, bonds, or cash, but it's according to your intended retirement date. That's the target. Now, that target date fund, it doesn't lower your risk. And by the way, it does not allow you to avoid losses when the markets tank. But what it does do is it makes it really easy to invest, especially when you're starting out. Just before you use one, take a little peek at the expenses of the fund. Sometimes target date funds can cost more than the index funds that are also offered inside of a lot of plans.
Jill, let's not use those words, markets tank, ever again, okay?
Oh, sorry. I'm sorry.
Jill, thank you for joining us today. Always great to see you. And you can see Jill regularly on CBS Mornings and the CBS Evening News. For more analysis, go to JillOnMoney.com.